Have you ever wondered what it's like to invest in real estate without debt, or why more operators don't take that route, even though it reduces risk? In this episode of the Passive Income Playbook on the Best Ever CRE Show, we're joined by Joel Friedland, a veteran industrial real estate investor and founder of Brit Properties based in Chicago. Joel has over 40 years of experience, has acquired over 100 assets, and now leads a team that buys assets entirely with cash, a strategy that bucks the trend and prioritizes safety and staying power over leverage and upside. If you're a passive investor curious about the industrial space, or you're just wondering what it really looks like when operators put investor protection first, this conversation will change how you think about syndications. And with that, I'd love to welcome Joel.
Hi, Pascal. Nice to see you.
Hey, good to have you here. So, Joel, I'm excited to talk about many things here. Everything from maybe what LPs should look out for if they're investing in this space. You have a very unique strategy of investing without any debt. But before we dive into all of those pieces, I would love for you to just give us a little bit of your story of how you got into industrial real estate and the type of investing that you help LPs invest into today.
Yeah, I'll go all the way back to growing up in Highland Park, a suburb of Chicago. And I was an entrepreneur as a kid. I had a lawn business that I started when I was 14 years old. My parents were out of town and left us with a young couple who was taking care of myself and my two brothers. And I was 14 and I decided for some reason I had to go into the landscaping business. And I went door to door up and down the street I live on. There were about 60 homes on the street. Literally went door to door to each home, knocked on the door, rang the doorbell, and met with either the husband or the wife or both, telling them that I was going to be a landscaper for the summer and that I wanted to take care of their lawn. I can't give you the exact number, but I actually convinced more than half of them to say yes. It was probably because I was too cheap. It's probably at the time I would mow someone's lawn for $8 a week.
Yeah, and everyone likes to help out the young gun, and I'm sure you got an incredible tan that summer.
It was a really busy summer, a lot of tan. So I went to a place called Ferraro Garden Center, which was in the next town over at a place called Northbrook. And I told Mr. Ferraro that I had started a landscape business and I bought from him on credit because at the time I didn't have a credit card. I was 14. I bought from him dozens and dozens of bags of Scott's fertilizer, spreaders that you would pour the fertilizer into to spread the fertilizer on people's lawns. And I bought 6 lawnmowers and all kinds of garbage bags and rakes. And then I went to a group of my friends who lived in the neighborhood and I hired them to cut the lawns.
Man, one up on the way I started business. Get the business and then hire other people to do it. That's pro.
Yeah, I put all the landscape equipment in my garage and I had to hire a neighbor who could drive, who had a pickup truck to go pick up all the materials. My parents got back from their trip. They were in California and they opened the garage and they came in the house and they said, "Young man, what did you do?" I said, "Over the weekend, I started a landscape business and I bought all the supplies." So it was a busy year and I continued as a landscaper for the rest of high school and even into college. So after graduating from the University of Michigan, I decided to go into real estate and I cold called a real estate company owner by the name of Milt Podolsky. And I told him that I wanted to be in real estate and he said, "Come on over today, I'll interview you." And I went to his office, which was over by O'Hare Airport, and he interviewed me and I got hired. He said to me, "I have empty buildings." It was 1981. I have 10 empty buildings. I need tenants. He had 84 buildings total, so 74 were leased. He said, "If you can cold call like that you did for your lawns in industrial parks to find me a tenant, you'll go door to door to door and you'll ask the neighboring tenants if they would consider moving into one of the vacant buildings." So that's what I did. I started out making cold calls in the industrial real estate market of Chicago, and Milt was very satisfied. I made a bunch of leases. I leased up almost all of them in the first 6 months.
Wow.
Yeah.
Wow. What a young gun.
I was crazy. I would start early in the morning going door to door, and I would continue until 6 at night. And I just didn't stop. I was on a tear. I wanted to show Milt that I could do it. So I became an industrial real estate broker. And I did that working for the Podolsky family, for Milton, his two sons, and his daughter. And they were syndicators. And over the years while I was there, they taught me how to be a syndicator. And finally, I said to Milt and Steve, his son, I said, guys, I want to do my own syndication. Will you help me? And they said, we will put up a third of the money for the deal that you do, and we'll introduce you to our investors that you don't already know. And you can call the investors that you do know and see if you can get them to go in. But you got to get your own people. If you're going to be a syndicator, you got to know how to find your own investors. So I did a $560,000 industrial deal in a little town here called Gurnee, Illinois. And I went to Milt's people and they invested. And then Milt and his family did what they said. They put up a third of the money. And I brought in a few other investors for $20,000 each. And that was my first deal.
Wow. How old were you?
I was 29.
Wow. What a
Yeah.
way to get in the game.
Yeah. I had invested with Milt in some deals, and I had invested with someone else. I was an LP first. So I knew what it felt like to be an LP. So it was easier for me to tell people how I was going to be the GP and they were going to be the LP and how it would work. So I was able to communicate it pretty clearly.
Yeah, and then from there, that's when your career really kind of started taking flight. Is you started doing your own deals, and I mean, what, 20, 30, 40 years later, still doing the same thing?
Yeah. I started with one, and we just bought our 104th building last week.
Congratulations. That's an incredible feat.
It's a lot of work.
I hear that. Okay, so amazing background. So can you, for the LPs that are listening, I would love for you to dive into a 1,000-foot view of what is industrial. Give us the whole landscape of, I think I listened to another podcast where there's, 3,000 industrial buildings in Chicago alone. I don't know if you know that stat around the United States. Maybe what are the different types of classes of industrial? Pretend we know nothing and help us learn about this asset class.
Okay. Well, first of all, there are 3,000 industrial buildings that are larger than 100,000 square feet in Chicago. There are 17,000 buildings that are under 100,000 square feet. And an industrial building is a place where products are either manufactured or distributed. So I'll give you an example. If you're driving along the tollway in any major city today, any suburban area, you're going to see these gigantic concrete buildings. They have what are called tilt-up or precast walls with lines of docks, loading docks, and many of them are occupied by Amazon and by other companies. Like Target has an online business, so they have a warehouse. But they also, for their stores, have to warehouse their products someplace when they come in from wherever they come from to be sent to the store. So they get sent from a warehouse. And so warehousing is the big visual, the kind of properties that when you see them, you know them. But there are these little industrial pockets in every single town in the world. And in those little pockets are smaller buildings where family-owned companies manufacture products. I'll give you an example. So look at your microphone. See, it's a Shure microphone. Mm-hmm. So Shure has a warehouse. In the warehouse, they keep all of their completed microphones, but they also have manufacturing buildings in other locations where they take the components, every little part in that microphone is made someplace, sometimes in the US, sometimes in China or in a different country, in Germany. Every product ends up in an industrial building or starts as a part in an industrial building. And these little tiny small units that are like 2,000, 3,000, 4,000 feet is where a lot of these companies got their start. And very often from people, it's interesting, from Europe, a lot of European immigrants came here 100 years ago, and they had skills and they knew how to make things, and they would open a little business and they would make products, and then they would sell more and more and more, and then they'd hire people to make more, and then they needed more space. And the buildings that are in these little industrial parks are primarily called Class B. They can be any size from 5,000 square feet to call it even 1,000,000 square feet. But most of the Class B have lower ceilings. than these giant Amazon buildings. Those are the Class A. The newer buildings are Class A. They have something called an ESFR sprinkler. It's like a deluge system where if there's a fire, bam, the water just comes from the sprinkler heads, and puts out the fire as fast as it can because they don't want the whole building to burn down. And the deluge system costs more and requires a fire pump. There's all these technicalities. The little Class B buildings, they don't have that. They have an old-fashioned sprinkler system, or if it's a small enough building, they may not have even a sprinkler system at all. All of these buildings have truck docks because you can't move anything in or out of a building on the bed of a truck, which is exactly 4 feet off the ground. When you're driving behind a truck, every truck, the bed of the truck, which is the bottom of the door, is at 4 feet. And the docks on all of these buildings are exactly at 4 feet, so that when the truck backs up to the dock, it meets at the same level. And then there's a metal plate that goes over the gap so that a forklift can drive in and out and take products out of the truck and bring products into a truck without falling into the gap.
Today I learned.
Yeah, that's industrial. That's called a leveler. They're called levelers, or some people used to call them levelators. So there's just so much technical aspects of the industrial business that I could go on and on and on and bore you and everybody else for a long time. The key thing is that when companies move into an industrial building to be a manufacturer, they don't leave. They just stay. They're called sticky tenants. And the reason they don't leave is because the cost of setting up equipment is super high. And as they grow and they add more and more machines, it gets more and more difficult for them to relocate those machines. And in addition to that, they have people who work there who are trained. So moving away from the location would kill their business. So they just stick around. We have at the moment, of all of our 22 buildings that we currently own, 16 of them have tenants that have been in the buildings for longer than 15 years.
Wow. That's like even higher than mobile home park tenant stays, which I think average around 7 or 8.
It's amazing. They don't like to leave. Costs too much.
Okay. So I'm gonna recap. So what you mentioned, are there only 2 types of classes in the industrial sector? So you mentioned Class A is like your high ceiling specific type of fire sprinkler. Maybe there's some other technicalities of like things that are required to quote unquote be Class A. Class B is maybe your average, let's call it your average Joe. Shorter ceilings, normal fire sprinklers, maybe the step up from someone's garage in terms of building a business and bringing inventory in. And then there's basically 2 types of tenants: people who manufacture things and then people who distribute things. And maybe a tenant can be both. Is that the landscape, or are there any parts we're missing?
There are other parts. Ultimately, there's really no such thing as a Class C. Class B can be on a scale of 1 to 10. So there is no C. Some people say, oh, Class C are just older buildings with lower ceilings that don't have good loading. And you could say that, but the question is, when does a Class B turn into a Class C because it's not as good? So I rate them on a 1 to 10. So there could be a Class B building that's a 10. There could be a Class B building that's a 1. Anyone in our industry would know what a 1 Class B is. If they were to look at that scale, they'd say, oh, dirty, bad parking, low ceiling, no sprinkler, old offices, leaky roof. That's a 1. A 10 would be not quite as tall and maybe not an ESFR sprinkler as an Amazon building, a little bit lower. That would be a Class B 10. You know a 10 when you see one.
Yeah.
Right?
Yeah,
right.
Totally. Okay, so and then let's walk through maybe the different types of tenants. So we talked about your average Joe or smaller business that is renting out these smaller spaces, and then there's maybe this Amazon type. Help us, give us the gamut of tenants and where they fall into. You mentioned Target. Walks through it before I start listing out a bunch of ones that I will regret.
Yeah, right. Okay, so let's start with the most basic. Startup company. Somebody worked for a company like I worked for the Podolskis, and then after 10 years, they taught me the business, and I went and started my own company. Stayed friends with them, and I still am close with Steve Podolsky, and he still invests with me. But I moved on and I started my own business with a group of other industrial people. And that's what happens. Usually it's someone works in an industry for someone who's got experience and has a viable company. And then they say, you know what, I could do this as well as my boss. I could go do my own. And usually they start pretty small because you need capital to start a business. I had a client when I was a broker. They were in the business of supplying water heaters. They were distributors of water heaters. It's called Shamrock. And they were in the city of Chicago in a building. It was 3 sons of one father and 3 sons-in-law of the other father. And the 3 sons-in-law didn't get along with the 3 sons. So I get a call from someone I know who's one of the sons-in-law. His name is Chuck. And he says, hey, Joel, we're leaving. We're leaving Shamrock. We're starting our own company. It's going to be called Cast Marketing. And so my 2 brothers-in-law and I are going to go into competition with Shamrock with the brothers. I said, well, that's not a happy family Thanksgiving. He said, no, it's not. And so we went and found them a 20,000 square foot building in a town here called Bensonville, which is right next to O'Hare Airport. And they leased the building and they grew and they grew. And they needed 40,000 feet, and then they needed 50,000 or 60,000 square feet. And if you're a distributor, it's easier to move than if you're a manufacturer, because really as a distributor, you just have to load your stuff into some trucks and move it to the next building. So that's an example of a distributor that starts small and then grows into a bigger company. Today, I was in Addison, Illinois, at a building where they make plastic parts. And these plastic parts go into something larger, which is motors. They're parts for motors. And they're very special. The plastic that they're made of has ground glass in it, and it also has something, a resin, like a material, so that it doesn't melt in the motor, because motors can get hot. So
Right.
It's specially treated. This business was started by a man and his brother in the 60s, very small, in a town called Broadview. And they grew, and the brothers split. And then one of the brothers brought his son into the business. And then they grew and they moved this company to Addison, where they have a 20,000 square foot building. And now the grandfather passed away, unfortunately, from COVID. The son is in the business and he brought his daughter in. So there's so many family companies and they occupy industrial buildings. They own the company and they own the building. So we buy buildings like that from families who no longer want to own the building. That's our niche. Class B, buying from family-owned companies or families that own a company and no longer want to own the building, or who sell the company to a private equity group. And the private equity groups never, ever want to own the real estate, because they can do much better manufacturing and distributing products than they can by owning a building. So we lease to an awful lot of private equity group owned manufacturing companies.
Can you, this is actually just a perfect segue into your specific strategy. And I want to focus on the debt piece in a minute. But what I'd like to dive into is how did you dig into your particular strategy? You know, you mentioned you're in Class B, you're just in Chicago, you know, you like to buy a certain type of building. And, you know, with each operator, there are so many different approaches of how you can buy or create value, right? Like you could develop these things, and that's your business in industrial. Why have you decided to focus kind of specifically in the niche that you play in?
Okay, so what I did not mention earlier is that there are multi-tenant buildings and single-tenant buildings. The multi-tenant buildings they're not quite like multifamily. They don't have dozens or hundreds of units. Buildings are, let's say, 100,000 square feet if they're multi-tenant, and maybe they've got 4 units of 25,000 each. I don't buy those. Those trade just like multifamily and just like self-storage. They trade for a cap rate. I'm in the business.
And cap rate, for those who are listening, is like the amount of revenue that is produced based on the value of the building. So
right, if it's
$1
$1
million
million
building,
it's the net operating income, more or less, that the building generates from the tenants.
correct.
So
Yep.
if you buy a building for $1 million and you want a 7% return, that's called a 7 cap. So that means
Perfect.
capitalization rate. So in our case, we buy a lot of buildings for $1 million or $2 million or $3 million. The kind of rent we get from a tenant is in the neighborhood of, let's say, $8 a square foot per year. So if it's a 20,000 square foot building, it would be $160,000 a year of rent. In a building like that, for me to get an 8% return on it, I need to own it for $2 million. However, if it was a multi-tenant building, it all depends on what another investor would want as a cap rate to determine how much that investor would pay us to buy the building. We do something totally different than that. Our strategy is we buy single tenant buildings where it's a net lease. There's not shared space. There's not a shared parking lot. They don't have common walls. It's just one single tenant. And that tenant occupies the building, uses the parking lot by themselves, uses the truck docks by themselves. And that operation is what I'm talking about, staying in a building for a really long time. A freestanding, self-contained building is really, really valuable to a user who just doesn't want to share with other people in the area. They might have an odor. They might have a noise that they make. They don't want complaints from neighbors. So these freestanding buildings are at a premium. Everybody wants to be in their own building. It's the difference between being in a townhome and being in a single family house. Some people just prefer having a yard in a single family house. They don't want to be sharing a wall with a neighbor. So the strategy that we have is we buy the buildings with one tenant, and then we renew the lease, and we renew the lease over and over for years and years. And if the tenant ever leaves, we don't sell the building to an investor. We sell the building to a user, which is another company that would need the building for their business as a tool for their business. The reason that we do that is because someone who's got a manufacturing operation, like the plastics guy I was with today, he doesn't look at what the cap rate is. He's not buying a building for a 7% or 8% return. He's buying it so that he can operate his business and sell $15 million a year of plastic stuff and make $1.5 million profit for his family.
He's looking at the lease totally differently.
Right. He looks at it and says, what's the difference if I pay an extra $3 a square foot? Instead of $8, I pay $11 a foot. I need the building for my business. So that extra $3 gives us a much better return. And that company needs to be in the building, and they want the freestanding building. Even totally different from that is the exit strategy is we sell to people like that who are willing to pay 30 to 40 and even 50% more to buy that building for their business than an investor would pay. And so we've got 104 buildings, and of the 80 some buildings that we've sold, 75 of them have been sold to users for user pricing, people who needed the building desperately for their business.
Wow. That is a unique nuance.
It's a twist. I think it's the only real estate asset class where this is true. Single family homes, it's true for that too. Somebody buys a house because they want to live there. If a house is on the market for $1 million and there's a bidding war and a family comes and looks at the house and they love the house, today they might pay $1.3 million for it over the asking price because they really, really want that house. And we're seeing that in today's market. People buying for higher than an asking price. In industrial, it's the same thing. If someone really wants a building because it's in the right location, it's the right shape, it's the right size, it's got to have the right geometry. It has to be laid out a certain way. The parking has to be adequate to be able to accommodate their employees because people drive to work. If there's not enough parking, they can't have employees because there's nowhere to put their cars. So you got to have enough parking. The loading docks have to be adequate. They have to have proper maneuvering room because trucks are gigantic and they need room to turn around and back into the dock. So each building is very specific, and we're incredibly picky. We buy buildings with good geometry and good locations that we believe we can lease easily. And then if we ever sell, we could sell at a premium to someone in the area.
Can you talk a little bit about the nuance of maybe location? I'm imagining, I used to live in Denver, Colorado, and, I think there were, many different Amazon facilities that some facilities are really close to a highway and some are much further inland. And I imagine property that's closer to a highway is more expensive. And maybe if you're a manufacturer, you're more likely to be further away from main highway roads, or maybe not. I don't know. Maybe you need to be closer to railways or things like that. Talk about that kind of location nuance in the industrial niche.
Well, you're right. Being near a highway is a premium. People pay a premium price to be there, but they need to be there because the cost of driving a truck a long way off the highway to a facility is really expensive because you're paying for truck driver time. Truck drivers paying for more gas. It's not as convenient. It's not as easy to find. However, we call it infill when it's near the city or when it's near, let's call it the major airport in a particular city. A premium is paid for buildings near or in the city, and also a premium is paid for a property that's really close to a highway. A double premium is paid for something close to a highway that's near the airport or that's near the city or in the city. So those are infill, like filling in the inner area. But there's no land left in the infill areas. There's nothing available anymore because as cities have grown, residential's popped up, retail's popped up, there's industrial that's been there for a long time. So new industrial is built now on the outskirts because often, depending on what city it is, there are farms that are as far as the eye can see. And farmland is what's needed to build those gigantic buildings. And so when developers collectively pick an area that's going to become a big industrial area, usually it's because they know that in the future, the highways, when they're extended in that town, based on looking at the Department of Transportation's long-term plan, they plant buildings where they know the highways are going to be in the future, or if there's an existing highway, they want to be as close as possible so the trucks can get on and off the on and off ramps quickly and get to the building. So infill is a different animal because that's where you have more employees in a concentrated part of town. When you go out to the farm areas, there aren't as many people living there. It's harder to hire people. So there are all these nuances, and we focus on infill. We don't like buildings that are way out there because when the market gets bad, and it ultimately does get bad from time to time, the buildings that lease the last are the ones that are far out because they're not as desirable as the ones that are infill.
Talk to me about purchasing existing industrial assets versus developing new ones. I'm imagining something I would like to get into here in a minute is macroeconomic trends, especially with the Trump administration moving manufacturing and like all of that onshore. Yeah, talk about maybe the risks or the different strategy approach between those two approaches.
Sam Zell, who was one of my favorite role models, said, I don't want to develop anything. It's too much work and there's too much risk. I believe that for us. I have developed about 30 buildings and I have not had a good experience with development. Development works if you do a mega development. The developers who build these really big Amazon buildings, they do great. And here's why. They use pension fund money. It's not from guys like us. It's not syndicated money. It's pension fund money. So they start out with hundreds of millions of dollars to put into an industrial area like this. And they can take the risk because if you're a pension fund, if you're the California teachers and you've got billions and billions of dollars, a $250 million complex is like a nothing. So they put $250 million into a million square foot building next to another 700,000 square foot building. They build it speculatively. Speculatively means that they have no tenant when they put it up and they're hoping to snag a tenant, and they usually do. Buildings like this have been built year after year over the past decade, and they mostly fill up pretty fast. That kind of development costs less per square foot. But when you build a smaller building, the price per square foot goes up. They're not being built. I will tell you that in the Chicago area, there are 20,000 industrial buildings, and there have been maybe 5 industrial buildings built under 50,000 square feet in the last 5 years. So wow. When they talk about absorption and multifamily and people developing down the street and you don't know who's going to be competing with you, for industrial in what I call the Class B smaller space, there's nobody building any, it's a totally limited supply and there's always demand. So it's a really weird business. Like nobody's building it.
Yeah, noted. Okay, so before I get in, actually, maybe now's actually a good time. So let's talk about the other part, the key part of your investment thesis, which is buying without any debt. Let's talk through the why, how that works. I was before we hopped on this call, I was looking at some of the current open offerings that you have available, and there are projections, I will say, and I'm not here to like promote Joel's deal or anything, but I wanted to just comment that the types of projections that you're talking about are like 6 to 9% cash on cash returns on a building without any debt. And I thought that was it was very comparable with what seemed like significantly less risk. So yeah, let's talk through that. What made you start that way? And what makes you continue to do that way? And pros and cons of that approach.
So I'm 65 years old and I've been through 4 downturns. And what I have learned through downturns is that real estate is very much subject to the ups and downs of the economy. And I was a big risk taker when I was younger. When I was in my 40s, at one time, I had 50 buildings. I had debt on all 50 buildings. I had 7 banks. I had guaranteed $70 million worth of debt because guarantees were part of the game. And I got hit with the worst downturn, 2008. It was a time when it didn't matter who you were or what you did, the whole world was in trouble. So I had 10 problem buildings where tenants were in trouble or where leases came up and they wanted to offload some expenses. So they moved out and consolidated into one of their other buildings, or maybe they closed a particular division of a company. And I got into so much trouble in 2008, 9, and 10. I hope nobody has the experience of getting into the workout department at a bank. That's where the department that takes care of defaults and takes care of loans that are not in good standing. And I was in the workout department at 3 of my banks. And they're not nice. They are not nice. They can do lots of very bad things. And you get put into something called a forbearance agreement. That's sort of like an extend and pretend. They say, well, you're in trouble with this deal and we'll give you more time, but we're going to increase the interest rate and we want you to pay down the debt. Well, pay down the debt with what money? There's
Right.
trouble everywhere. So it's really kind of like being executed. The bank has no sense of humor. They're not going to be friendly about it. We have one bank that was friendly about it, and we're still with that bank, and we're not with the other 6. But we're with that bank on old deals because my new deals, because of what happened in 2008, I decided that I just didn't want the risk of owing money. It's biblical. If you read the Bible, they say that a borrower is a slave to the lender. And there's all kinds of different stories about this and movies about this. A Man in Full, which was a book and a movie that was exceptional, about how real estate guys are often deal junkies. And you don't want to be an anything junkie. Like if someone said to you, hey, I'm a junkie, you'd say, you need to go to rehab. If you're a junkie.
Yeah.
Well, I don't like the idea of being a deal junkie. I like the idea of being a careful, methodical, strategic owner of buildings. As a syndicator, I want to be able to explain to my investors that when you go in a deal with me, there's no lender, there's no risk of foreclosure, there's no risk of losing the building, having to sell it at a discount, because we don't owe anybody any money. The problem with that is I have to raise 3 to 4 times more money from my investors, and it's a lot of work. Because if you buy a building for $5 million and you have an 80% loan to value, you're raising $1 million. But if you do it all cash, you're raising $5 million.
Right.
So instead of, let's say, having 10 investors at $100,000 each, now I need 50 investors at $100,000 each. And it's a lot of explaining and it's a lot of work, but it's safe. It allows me and it allows my investors to sleep well at night. And I'm not saying that everybody should do their deals without debt, but I believe in diversification. And I do think that if you look at people's portfolios of where they keep their net worth, where they keep their nest egg, if you're in the markets, they talk about a 60-40 split, where maybe you have 60% equities and 40% bonds. And I believe maybe it should be 50% equities and 30% bonds and 20% alternative investments, like what you get involved in and what you know about. And real estate's a big one. So maybe it's 10 or 15% real estate. If you do have 10 or 15% real estate, let's say that you have a $10 million net worth and you have 15% in real estate, maybe 300,000 of that should be really, really safe. So I only have a small amount from each investor of their total net worth. And I tell them, you don't want to put all your net worth with me because it's one asset class. It's just real estate and it's specific. It's just industrial real estate and it's specific. It's only Chicago area industrial real estate. Because I'll tell you how I got burned in New York, Ohio, and Florida, not knowing the markets back then as well as I should have. I'm really laser focused on a market where I know almost everything there is to know about the market.
Yeah, I mean, just listening to some of your other shows in preparation for this, it was like, you know exactly what buildings are on the market, when they've turned, who the tenants are, who the potential tenants could be, how long they've been there. I mean, if you've been in that market for 40 years, that you are like the OG player who is knows what's up in the area and knows what price per square foot you could pay and how that's increased or decreased over time, which is, I think just one of the things I think if you're an LP listening to this, that, you need to think through as part of your strategy. Are you investing with an operator that's investing in multiple geographies? Or are they an expert in one? Are they doing multiple strategies, or are they focused on one? And I think you're highlighting it clearly right now.
Yeah, we own 3 buildings here in a town called Elmhurst. It's one of my favorite industrial parks. It's also a beautiful suburb, great schools, very close to the highways. And we looked at a building in Elmhurst about 2 years ago to buy, and it was an 80,000 square foot building. And we offered $7 million for the building at the time. And the seller came back to us and said, we're not interested at that price. We want to sell it for $10 million, not a penny less. And I already owned with a few groups of investors these other buildings in Elmhurst. I know what they're worth. And I said to this seller, I just can't buy your property. I won't do it. I can't pay you more than this. I read in a press release yesterday that the building sold, and it sold for $9 million. Now, I don't know what we would have bought it for last time we looked at it. I'm not sure how much more we would have paid if we knew we could sell it for $9 million. Maybe I would have paid $8 million, but at the time I had my number. I knew what I thought it was worth based on what the market was in that area. And I said no. And I called my partners yesterday and I said, did you guys see that building, the Hamilton building, sold? And they said, yeah. I said, I called the broker that was the agent and I said, what did it sell for? And when he told me the price, I said, I'm glad they bought it. I wouldn't have bought it for that. Wouldn't have done it. And if the market takes a dip, that building is not going to be worth what these guys paid for it. They stretched to a number that I just don't agree with. So
yeah, and that's stuff you can only know if you've been in it for a while.
Yeah.
I'd love to. So industrials, I think, a really interesting niche to discuss given the geopolitical climate that we are in with, I would say, love him or hate him. The Trump agenda, whether you believe him or not, is to bring manufacturing onshore for basically anything that the United States could need. And I'll highlight this here because I think, going back, if you look back at what happened during COVID, America was stretched to the point where they couldn't produce enough of the PPE, the medical supplies for COVID. The U.S. is not a great producer of ships anymore, and they're trying to grow their Navy and have the strongest military in the world. Don't have all the pharmaceutical manufacturing is in Ireland. And God forbid, whatever happens, we don't have that kind of access. That's why Trump is putting all of these massive tariffs in place in order to force all of these different industries to bring everything into the United States in order to make the United States protected given any kind of scenario. So given that, the hypothesis here, in my eyes, is that this would be probably one of the best times, probably over the last couple decades, to invest in this type of niche. Why or why not?
Okay, that is a complicated question with a complicated answer. So we're putting this together during the period of time that Trump is somewhat, shall we say, impulsively coming up with different tariffs for different countries for different reasons.
And let's just put a timestamp here. We are filming this in April of 2025. So we are right in the heat of Trump's tariffs having been put on and just recently in the last few days paused.
Yes. So first of all, I'm going to tell you this is great for industrial real estate. When I say great, I mean great. So what's going to happen is if I own a building in Elmhurst that I paid $9 million for, that building, if Trump's plans work out the way that he and his advisors think that it will, that building will be worth $12 million in 2 years. And if I have a building in Elmhurst that's worth $2 million today, it'll be worth $3 million in 2 years. If he's right. If he's wrong, I still think they'll be worth $9 million. I don't think they're going to go down in value. I don't think there's anything that's happening that's going to cause a blow up to the negative in this. But I'm going to tell you where the fallacy is. I'm a bit of a student of the economy. And one of my favorite podcasts, it's called Thoughtful Money with Adam Taggart, and I recommend it very highly. Twice a week, he interviews people who talk about the economy. I should be a guest to talk about one thing. Every company that I have as a tenant in a building, and every company where I go visit them and say, I want to buy your building, has the same problem. They can't find employees who are qualified. They're all desperate to find people. They have job openings. It's not that there's so many unemployed people in this country that it's amazing if we bring back everything and we're going to fill up all these jobs. We're not going to fill up all these jobs. Nobody's there to do the work. So the fallacy is we're going to build all these new manufacturing operations and people are going to work there. It's not going to happen. It's automated. They have robots. They have these things that look like people with fake white faces and fake white arms, and they move around and they do this and they do that. But the technology isn't there yet for every person to be replaced by a robot. AI is not at that point yet. So you need people, and there are no people. There are not people willing to work in this country who are qualified for the jobs that are open. So, for example, we bought a building last week from a company called QCC. They make motors and pumps for farm tractors. And he's got a giant sign in the front yard of his industrial building saying, bonus if you come to work for us, because they can't find people. So the fallacy is that we're going to fill up all these jobs. They're already filled up. I don't mean they're filled up. I mean they're missing. There's missing positions. So there's no people to do this work. How are they going to do it? In China, there's 1 billion people and they pay them much less money and they can do the same thing we can do here, but they can do it for a fraction of the cost. My tenants are saying to me, this is never going to happen because there's no one to do all the work for these factories that they're going to build. They're not really going to build them because it can't happen. It's not going to happen. We'd have to pay double and triple for an iPhone what we pay today. Your microphone, at least 2/3 of the components are made someplace and shipped here. If that microphone is a $600 microphone, it's going to cost $2,500 if we make it here. So it doesn't work. There aren't the people and the costs would be too high. So the question is, what happens? And the answer is he's going to back off of this because they're not going to bring all that manufacturing here because there's no one to do it. It's just the logistics don't work. It just doesn't work.
Fascinating, interesting take, and especially like someone much closer and on the ground than a layman like me. Help me understand a little bit more about the type of labor that's required. Like this, you've mentioned a little bit that I'm just imagining not difficult to move, maybe in the distributor phase where it's like, okay, you're moving things in and out, or is it really technical? Or like, can you give an example of maybe like what are the skills that you
Yeah,
think?
there's
Yeah,
three categories: super technical, moderately technical, and handwork. Handwork today in the United States is being done by immigrants who are illegal. If they leave, we're in trouble because then there's no one to do that handwork. It's grunt work. It's sitting at tables. I've been in thousands of buildings and I always walk by the lady who smiles at me. She smiles up and like, hi, and she speaks Spanish or whatever. And she couldn't say 10 words to me in English. And she's sitting there putting parts into other parts and then putting them on a conveyor belt and then putting parts in the other part and doing it again over and over. You going to take that job? You're not. No one you know is. It's a job that people come here and they're looking for any kind of work and they're hard workers. They're the hardest workers ever. People who figured out how to get here are hard workers. They worked hard to get here. They have ambition. They have ingenuity. So they have ingenuity when they're working on the line, making the little pieces. That handwork, that's one type of job. If there's mass deportations, there's going to be a gigantic sound, the sucking sound of all of the manufacturers who are here not being able to make their products here, and they're going to have to go offshore and make them somewhere else because the people won't be here to do the work. The moderately technical is a job that can be taught to somebody like an apprentice, that can be taught to somebody anytime, I'd say between 60 days, 2 months, and maybe 6 months. And it's a job where you can't just step in and start doing something. You have to be trained. And that trained labor is a problem because there are very few people who qualify today that are actually unemployed to take those jobs. That's the kind of job that QCC, my tenant, is trying to fill. They're trying to figure out how to get people in to do moderately technical work that they can train, who are going to stay. Because once they start training them, they put all this money into training. And they pay a person to train them, and they pay the people while they're being trained to work there. They don't want them to leave. So they've got to keep them in place. And then the very highly technical, it could be engineers, they could be people who take years to train, and finding people for those jobs is really hard. People that we know, our people in our community, your community and mine, they want to be executives. They want to come in when they want to come in. They want to work from home. No one can work from home if they're in an industrial company. They have to work in the warehouse where they make stuff. They can't
right.
make stuff. You can't have people going home and working in 14 garages and then bringing their car to work and assembling it all in one day. It all gets sent to one place and they all work at the same time in the same place. And there's an assembly line. In the assembly line, it's interesting. The way that it works is raw material comes in one side of the building and it's stored there. And then there's a middle section where the assembly and manufacturing is done. And then there's the other section where the finished product is stored in boxes and shipped out. That's how manufacturing works. Raw, work, out. That's how they're set up. And each person that works on a forklift truck has been trained where to find products in the raw material racks and where to bring products and take them from to put them in trucks in the finished product racks. And the people in the middle have been trained to put little pieces together. And the highly technical people are designing things and working on very highly sophisticated machinery that requires, they're called CNC machines. It requires sort of like an engineering knowledge because inside the machine, there's a process happening and there's a keyboard and you actually have to use the software to design how a process is done inside one of these machines.
Wow.
And all those machines, by the way, they're all made in Japan and Germany and Switzerland. So we got to buy them from them. We're not going to start making machines. Siemens, all the medical equipment, what are we going to do? Like start competing with Siemens? They've got a foothold in the hospitals. If you ever go for an MRI, you're in a Siemens machine. They're not going to make one somewhere in Arizona. It would take them 10 years to figure out the technology and then start selling them to replace the machines in the hospitals that are made in Germany. So the whole thing is silly. It's silly. It's an international world. You can't go backwards. What they're trying to do makes no sense. Yeah, there's an unfairness to tariffs if we're at a trade deficit. But instead of doing it impulsively, there should have been a strategic plan planned out for months with very smart people behind the scenes, worked it out. Everybody's happy. instead of this crazy stuff.
Man, all right. I like it. I like a good take. Okay, so to kind of put like a bow on this, I mean, one of the things that, if you're an LP listening to this, if I'm an LP and I'm thinking about investing in industrial, this is kind of what I'm thinking about. I'm asking myself, is this a good play? Is this a good niche that I want to bet on? What should I be thinking about given everything that's happening? Like, it sounds like worst case scenario, you think we're going to be where we are. And if Trump miraculously pulls off this, which you think is highly unlikely, everything should be worth a lot more in this particular niche. Is that kind of your thesis?
Yeah.
What should we be thinking about? What is the reason we should consider industrial given everything, given the turmoil that's happening?
Well, first of all, diversification, number one. Industrial shouldn't be the major thing that any one person does, although there are people like me who have a lot of industrial investments. But diversification, it is a different asset class, and it's good to have different asset classes. It's a very steady and stable one. Industrial has been around forever, ever since products where food is made in industrial buildings. You can't open your refrigerator without touching something that was made in an industrial building. Whether we have a company that makes drinks, fruit drinks. It's called Tampico, and they're all over the world. It's like, yeah, fruit juice. Someone makes it somewhere. We own the building. So you're investing, and they can't leave. And industrial rents go up every year, and they're locked into long-term leases. So the risk is that a tenant goes out of business or leaves. And the way that we try to mitigate that is with the no debt. So industrial is great. Industrial is great. And people have made a fortune in industrial. And it used to be a quiet little section of the market that nobody knew about except for a few of us. And now more people know about it. And I think that the key thing is that the tax benefits are great. We do something called cost segregation studies. So the upfront tax savings is amazing. It's like a tax-free investment for the first few years. And the rents go up and the tenants stay. And it's not we're making projections. We actually have long-term leases, and the projections aren't projections. They're the scheduled rent that are in the lease. So that's really good. And then in our case, we sell them for a premium to users. And that's our exit strategy. And we couldn't care less what cap rates are.
Love it. Love it. Joel, this has been incredible. Where can people go learn more about you? Maybe join your investor list, and just follow your world.
Sure, we have a website. It is britproperties.com. BRIT, just one T, properties.com. We named the company. I used to have another company, and I sold it with 12 of us were partners. We sold the company, and after a while, we started this new one, and we had a property manager named Brad. We needed a name for the company. So Brit stands for Brad really is terrific. We told him we've named the company after you, even though you're the property manager. He was so happy. It's better than giving him a raise, naming the company after.
I could imagine.
Yeah.
Amazing. Thank you so much for joining us today, Joel. For those of you who are listening, if you want to access and uncover deals like the one Joel here is talking about, his type of deals, you can grab them through my Passive Investing Starter Kit at passiveinvestingstarterkit.com. It's one of the best ways to see quality 506c opportunities in your inbox, along with different tools to invest with more clarity and confidence. And thank you so much for joining us here on the Passive Income Playbook, part of the Best Ever CRE Show. We drop new episodes every Thursday, so be sure to tune in every week for more real conversations, strategies, and stories to help you grow as a passive investor. If you enjoyed today's episode, please subscribe, leave us a 5-star review, and it really helps us reach more investors like you. And thanks for tuning in. I'll see you next week for another episode of the Passive Income Playbook.